Welcome to the deep dive. Today, we're cutting straight to the heart of Bitcoin and, the wider crypto market.
Yeah, lots happening.
We've got a fresh update here from Blockchain DXB. It's dated May 1st, 2025. And our mission, well, it's simple, really. Make sense of the recent market swings, the big news driving them thinking about potential interest rate shifts, institutional power plays,
Right.
and that ever-shifting regulatory landscape. I just want to give you the essential insights without, drowning you in jargon.
Exactly. And this blockchain DXP update, it's really packed with crucial stuff, a real snapshot
Right.
of the key forces shaping crypto right now. We're here to break it all down.
Okay, let's dive right in then. How about the overall market sentiment? Alternatives.me shows a slight dip, right? From 60 down to 56.
Yeah, a small drop from 60 to 56.
Mhm.
Suggests maybe a bit of cooling off, maybe some caution creeping in.
So what's behind that caution, you think?
Well, it's likely a mix of things, but that looming Federal Reserve interest rate decision next week,
Yeah.
that's got to be a big one.
Right.
Uncertainty around monetary policy usually makes investors a bit more risk averse across the board, really. And that definitely ripples into crypto.
And the big picture numbers reflect that a bit too. Global crypto market cap, small decrease, down to $2.94 trillion. It was $2.99 trillion.
Marginal dip, yeah.
But interestingly, the total volume jumped up significantly, actually. 7.61% increase to $81.91 billion. So lower market cap, higher volume. What's the story there?
Well, that combination often points to increased trading activity, maybe some profit-taking or people reallocating their holdings. The fact that more assets are changing hands, even with that slight value dip, it suggests there's still a lot of maneuvering happening sort of beneath the surface.
Okay, and here's something that really jumps out at me. Stablecoins, the volume's slightly up, $76.67 billion. But get this, it makes up a massive 93.60% of the total crypto market's 24-hour volume.
93%.
Right. Tether USDT is leading, $62.76 billion. Then Circle's USDC, $9.90 billion, and FDUSD at $2.60 billion. 93%. What does that tell us?
That is huge. That overwhelming preference for stablecoins in trading, over 93%, it really underscores a market that's prioritizing stability.
Amidst the uncertainty you mentioned.
Exactly. It suggests, potential hesitancy to dive into the more volatile assets right now. Stablecoins are the bedrock for trading. They provide liquidity, but their dominance now really highlights where the immediate focus is: stability.
Okay. And turning to decentralized finance, DeFi. Total volume there is $6.32 billion. That's what, 7.72% of the total crypto market volume?
Still significant.
Total value locked, $1.22 billion. And Uniswap is still the king of the DXs, $1.55 billion in 24-hour volume.
Absolutely. And while DeFi volume is, like you said, a smaller slice compared to stablecoins, it's still a crucial indicator
Of innovation.
Yeah, ongoing innovation and user engagement in that decentralized ecosystem. And Uniswap's consistent top spot just shows the continued demand for those decentralized platforms.
Right. Now let's talk the big two, Bitcoin and Ethereum. Bitcoin's dominance still strong at 53.30%. Price is $94.73. Tiny dip, 0.13% over the day, but actually up slightly over the week, 1.808%.
Holding relatively steady there.
Yeah, it's 24-hour volume, $29.83 billion. Market cap, $1.86 trillion. Ethereum, though, dominance, 7.30%. Price, $1,783. Down 0.33% in 24 hours and 0.14% over the week.
So slightly weaker performance there.
Volume, $15.15 billion. Market cap, $215 billion. So Bitcoin seems to be weathering things a bit better. Why might that be?
Well, Bitcoin's resilience, in the short term anyway, could be tied to its perception, as a more established store of value, kind of a digital gold.
Especially when there's broader market unease.
Precisely. Ethereum, with its huge ecosystem of applications, dApp apps, it might just be more sensitive to those fluctuations in overall risk appetite.
Got it. Now here's something interesting. Deepin tokens, decentralized physical infrastructure tokens.
Yes, the Deepin space.
Think of them as digital representations of ownership or access to real world stuff.
Right.
Infrastructure.
Exactly. Bridging the physical and digital.
The top ones by market cap. The Tensa, $3.06 billion. Render, $2.28 billion. Filecoin, $1.83 billion. Then IOTA, $777 million, and Theta Network, $736 million.
Quite substantial market caps already.
Yeah, but the report rightly points out market cap is just one lens. You really need to look at 24-hour volume and, importantly, dApp activity, like on dappradar.com, to see what's actually being used.
That's a crucial point. Market cap shows perceived value, but activity shows utility.
So what's the significance of these deepened tokens gaining traction now?
Well, this trend signals a really fascinating evolution, I think. Blockchain tech moving beyond purely digital assets and starting to actually underpin real-world infrastructure.
Like data storage, computing power.
Right, network bandwidth. These tokens represent a way to decentralize the ownership and operation of those things. So while market cap gives an idea of overall value, like you said, the actual activity, the DApp usage, that's the true indicator of their real-world utility and adoption. It's definitely a space to watch.
Okay. And finally, for the market snapshot, Ripple's XRP. Significant 24-hour price drop, 4.78%.
Ouch.
And that's despite the recent news about an XRP ETF approval in Brazil. Even over 7 days, it's down 1.08%. You'd think positive news like an ETF approval would give it a boost, wouldn't you? What does this tell us about?
Well, the unpredictability.
Yeah, it really highlights that in the short term, broader market sentiment, maybe even the anticipation of the news, that can often outweigh the immediate impact of a positive development.
So the news was maybe already priced in or just overshadowed?
Could be either or both. It's just a reminder that the crypto market doesn't always react in a simple, linear way to news. There are always multiple factors at play, very volatile.
Okay, so that's the immediate market picture. But what about the bigger underlying factors that could really sway things? You mentioned the Fed decision.
Right. May 7th, Federal Chair John Tell. Big decision coming up. Keep rates steady, reduce them, or even increase them.
And there's political pressure too, isn't there? President Trump urging for lower rates. There is. The report notes that pressure suggesting a rate cut could potentially boost the U.S. economy and maybe crypto prices along with it.
How significant is this Fed decision for crypto, really?
Oh, it's hugely significant. Interest rate decisions impact all financial markets.
Right.
Lower rates generally make borrowing cheaper, potentially increasing the appeal of riskier assets like crypto as investors hunt for higher returns.
And higher rates do the opposite.
Exactly. Higher rates can tighten liquidity, maybe dampen enthusiasm for crypto. And yeah, Trump's public stance just adds another layer of intrigue to the whole thing.
Okay, digging deeper now into the macro environment, the Fed Reserve Board's Financial Stability Report from April, it gives a detailed assessment of potential vulnerabilities in the U.S. financial system.
Right, looks at asset valuations, debt levels, financial sector leverage, funding risks, the whole picture.
Let's break down some of the potential negative implications for Bitcoin and crypto highlighted in that report. One key concern: tight liquidity and market volatility. The report noted deterioration in treasury and equity market liquidity back in April.
Yeah, and what that practically means, well, when liquidity dries up in traditional markets, it becomes harder, maybe more expensive to buy or sell large amounts without moving the price too much.
So institutions get nervous?
They can become more risk averse, yeah. They might look to reduce exposure to more volatile assets, and Bitcoin certainly fits that bill sometimes just to make sure they have ready capital if needed.
The report also mentions high interest rates and treasury yields increasing the opportunity cost of holding non-yielding assets like Bitcoin. Can you unpack that a bit?
Sure. Opportunity cost is basically what you're giving up by choosing one option over another. So if you can get a pretty decent, relatively safe return from government bonds because interest rates are high, the incentive to hold an asset like Bitcoin, which doesn't pay interest or dividends, might decrease for some investors. They see a potentially safer return elsewhere.
Makes sense. Another potential headwind mentioned: unwinding high financial leverage. Highly leveraged hedge funds may be having to sell off riskier assets, including crypto, which could trigger wider sell-offs. We've seen that before, haven't we?
We absolutely have. When entities with lots of leverage face pressure, maybe margin calls, they might need to liquidate assets fast. And because the crypto market can be, relatively smaller or less liquid than traditional markets sometimes.
It has an outsized impact.
Exactly. These forced liquidations can sometimes really push prices down significantly.
And finally, on the negative side, the report flags tight credit, rising delinquencies on credit cards, auto loans, signs of consumer stress, meaning potentially less retail money flowing into crypto.
Yeah, they're quite interconnected. Consumer sentiment, disposable income, they play a big role in retail investment across the board, including crypto. If people are worried about jobs, paying bills, dealing with debt.
They're less likely to punt on crypto.
Pretty much. They're less likely to allocate funds to what they might see as riskier, more speculative investments.
Okay, but the report isn't all doom and gloom for crypto, right? It highlights some potential positives, too.
Correct. It's not forecasting imminent disaster.
For example, it notes moderate systemic risk. suggests the overall financial system is relatively stable, which could prevent a sort of widespread panic sell-off that would hit everything, including Bitcoin. Banks are reportedly well capitalized.
Yeah, and that's important. A stable traditional financial system provides a degree of, let's say, background stability. It reduces the chance of contagion. If major banks were in trouble, that could trigger a broad flight to cash, negatively impacting even markets like crypto. So reported stability is generally a good sign.
The report also mentions potential continued weakness in traditional assets. High valuations in stocks, maybe concerns about defaults in traditional credit. Could this actually drive investors towards alternatives like Bitcoin?
That's definitely part of the narrative. The idea of Bitcoin as a digital store of value, a potential hedge against inflation or instability in traditional markets, that has certainly gained traction.
So if people lose confidence in stocks or bonds or even fiat currency,
Some may indeed look to Bitcoin as a diversifier or, yeah, potentially a safe haven. It depends on the specific circumstances, of course.
and perhaps most interestingly, the report identifies U.S. fiscal debt and inflation as major long-term risks. That seems to play right into Bitcoin's core argument, doesn't it?
It really does. Bitcoin's fixed supply, its decentralized nature, that resonates strongly with people concerned about governments potentially debasing fiat currencies through, excessive money printing or just running up massive debts.
So macroeconomic worries can actually be a tailwind for Bitcoin sometimes.
Absolutely. Concerns about the long-term health of traditional finance can bolster the case for alternatives like Bitcoin.
Okay, let's shift focus now to some pretty significant institutional moves, specifically BlackRock. They've filed to introduce new blockchain-based shares called DT shares.
DT for distributed ledger technology.
Right. For their massive $150 billion treasury trust money market fund. This sounds like a really big step.
It is. It's a very significant development for an asset manager of BlackRock's size and influence, I mean, the world's largest, to move into tokenizing traditional assets like this. It signals a growing recognition of the benefits blockchain can offer.
Like efficiency, transparency.
Exactly. Benefits for mainstream finance.
They're partnering with BNY Mellon, and the idea is these digital shares will basically mirror the traditional ownership records, but on a blockchain. Enhance transparency, maybe pave the way for broader adoption of tokenized assets.
That seems to be the goal.
Now, crucially, the report is very clear. These DT shares will not hold actual cryptocurrencies.
Right, that's key. They're tokenizing the shares of a fund that holds traditional assets, like treasuries, not tokenizing crypto itself in this case.
So what's the long-term play here, do you think?
Well, by tokenizing traditional assets first, BlackRock is probably navigating the existing regulatory landscape more carefully. They're demonstrating the practical advantages of blockchain for things like settlement, record keeping, within a familiar framework.
Building the pipes first.
Kind of. But by building this infrastructure, they're also absolutely laying the groundwork for potential future integration with actual digital assets down the line. It feels like a very strategic step towards a more digitally integrated financial system.
And the report highlights this as potentially a major step towards tokenization becoming like the next big narrative in finance.
It certainly feels that way. It has a lot of momentum.
And this isn't BlackRock's first foray, is it? They have their blockchain-native BUIDL fund developed with Securitize.
Right, managing over $1.7 billion now.
And that's expanded to the Solana blockchain, too. They seem really committed to exploring this space.
Absolutely. They've been consistently exploring blockchain's possibilities, expanding DUIDale to different chains like Solana shows they're serious about understanding and leveraging various ecosystems. The DT Shares initiative just further solidifies that direction. They're not just dipping a toe in.
And we should probably mention Larry Fink, the BlackRock CEO.
Yeah.
He's been consistently pretty positive on tokenization.
Very positive, yeah.
Even made comments in the past about the U.S. potentially losing financial dominance and how Bitcoin might play a role. His voice carries immense weight.
It does. Fink's stance, his public support for tokenization, and even acknowledging Bitcoin's potential role, it adds a huge layer of credibility and mainstream acceptance. When he talks, traditional finance listens.
Okay, shifting gears again, let's talk regulation. Some interesting, maybe mixed signals coming out of the U.S.
Always a complex area.
First, the SEC. They've decided to delay the decision on the Franklin XRP ETF, pushing the deadline from May 3rd out to June 17th, 2025.
Another delay. SIBO had filed to list that one.
So what's behind this continued caution, especially around crypto ETFs beyond Bitcoin?
Well, ETF approvals are significant, right? They open up crypto to a much wider investor base via traditional brokers. The SEC's delays likely mean they still have outstanding questions or concerns.
Like market manipulation, investor protection.
Those are usually the big ones, yeah. Especially for assets beyond Bitcoin, they might require more specific due diligence regarding the underlying market structure and potential risks for that particular asset, in this case XRP.
Okay, but on the flip side, some seemingly positive news. The SEC, under the current Trump administration, has ended its 15-month investigation into PayPal's PYUSD stablecoin.
Right, and importantly, without any enforcement action.
That probe started back in November 2023 under the previous administration. Does this signal maybe a change in the regulatory winds, a different approach?
It certainly could. Concluding that probe into a major stablecoin like PYUSD without bringing charges, it does seem to suggest a potentially more, let's say, accommodating stance towards stablecoins, at least compared to maybe some previous postures.
Less enforcement heavy, perhaps?
Possibly. Maybe a greater willingness to work with issuers within a developing framework, rather than leading with enforcement first. It's a notable development.
And the report emphasizes this could be part of a broader shift. PYUSD, just for context, is issued by Paxos, backed by short-term treasuries and dollar deposits. It's been growing, partnered with Coinbase.
It's becoming quite established.
And this seems to align with a general move towards regulating stablecoins more clearly in the U.S. anyway, with Congress looking at bills.
Exactly. The regulatory picture for stablecoins has been pretty murky, ending the PYUSD probe alongside legislative efforts. It suggests a move towards finally establishing clearer rules of the road.
Which could be good for the industry.
Could be. More certainty for issuers and users could foster more innovation and adoption, assuming the regulations are, workable. And PYUSD gaining traction on major platforms like Coinbase definitely shows growing acceptance.
And this all ties back potentially to President Trump's stated focus on deregulation. The report highlights that as a possible tailwind for crypto.
Yeah, a less restrictive regulatory environment could certainly be seen that way by the industry potentially encouraging more innovation, more investment.
But there's always a balance, right?
Always. It's important to remember that some level of regulation is generally seen as necessary for investor protection, market integrity, preventing illicit finance. Finding that right balance is always the challenge.
Okay, finally, let's look east. Some really interesting developments in Dubai and the wider Middle East.
Yeah, that region is moving fast.
The Ras Al Khaimah Digital Assets Oasis, RAIC-DAO, has partnered with the Suhab Imine Accelerator Program. They want to capitalize on the UAE's Web3 momentum.
Makes sense. Build on that energy.
RAIC-MEO is now the official partner, offering regulatory clarity, licensing support for startups building on the Sui blockchain. And Suhab Imine apparently got a huge number of applications.
630 applications from 152 countries, the report says. Launched in Dubai last year. That's massive global interest.
And RAIC-DAO itself already hosts over 500 Web3 companies. It seems like the UAE is really leaning into becoming a Web3 hub.
Absolutely. This partnership highlights that proactive stance. Certain places in the Middle East are really trying to attract Web3 innovation by providing clear rules and support. They want to be the go-to jurisdictions.
And then there's Saudi Arabia. They've released a draft global AI law. Pretty ambitious goal. Redefining digital jurisdiction.
Very ambitious. And they're seeking public comment now until May 14th.
The proposal includes creating 3 types of AI hubs in Saudi: private, extended, and virtual. And this concept of data embassies.
Yeah, that's fascinating. Private data centers operating under foreign laws, but located physically within Saudi Arabia.
The whole focus seems to be on regulating the infrastructure first, not just the data, trying to support cross-border, data-heavy businesses, tackle those tricky data localization and transfer issues.
It's a very forward-thinking, comprehensive approach, isn't it? By focusing on the foundations, the infrastructure, and addressing those core concerns around data governance and cross-border flow, Saudi Arabia is clearly aiming to create a super attractive environment for global AI and tech companies.
That data embassy idea is novel.
It really is. Could have big implications for how international data gets managed and regulated globally.
They've detailed the hub types too. Private hubs, just for a guest country under its laws via treaty. Extended hubs for operators and clients under guest country laws. And virtual hubs.
Those seem really flexible. For Saudi providers hosting foreign clients, governed by the client's home country laws. They even defined guest country versus designated foreign state for the virtual hubs, making them broadly accessible.
It shows a really sophisticated understanding of different business needs, that tiered structure.
Definitely. The virtual hub especially could really lower barriers to entry, make cross-border digital collaboration much smoother. And asking for public comment shows they want to get this right, make it globally relevant.
Okay, so bringing this deep dive to a close, lots of threads here. We saw that slight market cooling, likely tied to Fed anticipation.
Waiting game there.
BlackRock's tokenization move feels really significant for TradFi embracing blockchain.
A potential game changer for adoption, yeah.
Then, the mixed regulatory signals in the U.S., the XRP ETF delay versus the PayPal stablecoin probe ending without action.
Right, showing the complexity and perhaps a shift under the current administration. Still unfolding.
And finally, these proactive, really innovative developments in the UAE and Saudi Arabia around Web3 and AI regulation and infrastructure.
Yeah, showing a different approach.
Yeah.
Actively trying to build hubs for the future.
What's really striking is how all these different things, macro policy, institutional tech adoption, global regulatory shifts, they're all converging, aren't they? Shaping where digital assets are headed.
Absolutely. It creates this really complex but incredibly dynamic environment. Things are moving fast on multiple fronts.
So here's some food for thought for you listening. With these traditional finance giants like BlackRock getting deeper into blockchain and new regulatory landscapes popping up globally, how might this fundamentally redefine our whole understanding of digital assets, financial infrastructure, maybe even global commerce?
Good question.
What unexpected opportunities or maybe challenges could this present for you personally or for your business in the coming years? It's definitely worth thinking about.
Yeah, maybe dig into that financial stability report.
Yeah.
Follow BlackRock's tokenization efforts. Keep an eye on those regulatory developments in the U.S. and the Middle East.
Yeah.
Lots to track.
Definitely. Thanks for joining us for this deep dive.